Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Elf Beauty, this makeup company down 25% pre-market after a Q3 earnings release that disappointed investors, especially on the guidance side. There's a lot of worries about future growth after the deceleration they're going to see in Q4. And this is a stock that's been pretty popular in internet investment circles simply because it went from $22 all the way to $215 in a matter of 2 years. I mean, that sort of return, you're certainly happy about that if you're an investor. If you were a buyer in this period where it was trading in the 200s or close to it, and now it's trading in the 60s and you're still holding, probably not very happy about that. Certainly, the rise here may be a bit too optimistic, but warranted by the growth that this company saw. This was a company that's been around for quite some time, but it really started to grow in 21, 22. You can kind of see the flat growth between 16 and 20, and then 21. Good implementation of marketing, good implementation of new product cycles. Suddenly the growth explodes 12%, 23%, 47%, 77%, and now that growth is starting to slow. And obviously the market often prices in expectations of a certain amount of growth for a company like this one, a relatively young, immature company. And now that that growth seems to be stopping and or slowing down, you're seeing the stock price react very negatively to that. So let's take a look at these earnings and see what they actually look like. On the surface, earnings look really good. Net sales up 31%, market share gains continuing, adjusted EBITDA well into the positives. And again, this is one of those companies that talks adjusted EBITDA, adjusted EPS. Look at actual EPS here. They're removing non-reoccurring costs that seem to be recurring. They're removing stock-based compensation, which is increasing every single year. So a lot of those things will make adjusted EPS look a lot better, but not a real representation of the actual EPS that they're getting. This is one of the reasons this company is doing so well, or did so well in the past. 24 consecutive quarters of net sales and market share growth. They're one of the few companies that are continuing to grow at 20%. They're continuing to gain market share every single quarter. It'll be interesting to see if that changes anytime soon, but certainly not the case right now. 40% net sales growth year to date. You can see there's a bit of a deceleration there. You're talking about 40% growth against 31% growth in Q3. So that means Q1 and Q2 grew a lot higher than 31%. And the important thing from the market's perspective is that you look at the net sales growth outlook that they're providing. The second half of 2025, which does include Q3, which remember grew at 31%, is going to grow at 14 to 16%. So you can do the math in your head, but it seems like Q4 guidance is super, super soft. You're talking about low single digits. And again, this is a stock that was priced for perfection in a way, especially at $200. So the assumption was that, hey, they're going to grow at 30% Q3, probably something close to that, maybe something slower, high teens in Q4. And now what you're actually getting is 1 to 2% guidance or something in that range to get to an actual net sales outlook of 14 to 16% for the second half of 2025. And that's why the stock is reacting as much as it is. You can go through all this nonsense, digital penetration, all of these beauty squad members, yada, 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 good stuff. What really starts to matter to me is where is the growth coming from in the future? So you can look at Q3 for 2025, the cosmetics category is shrinking. You saw that in the results for a company like Estee Lauder. The stock was down quite a bit. The cosmetics category as a whole is shrinking. And yes, e.l.f. is still growing, 16% growth in Q3 for e.l.f. Cosmetics. They're taking market share. But as they take market share, they become a bigger and bigger player in a shrinking market. And unless that market turns around, they're going to have trouble growing that much more because there's only so much share you can take. And yes, you can obviously become a much bigger player in the overall industry. And maybe that's what e.l.f. shareholders are expecting e.l.f. to do. But they're already the number one player in terms of unit share in mass cosmetics. And they're the number two player in terms of dollar share in mass cosmetics. So once you get to this spot where you're 14% of unit share and 12% of dollar share, how much further can you take it? And maybe they are in the 15, 16, 17, 20% range eventually. But this to me shows that they're sort of becoming more mature than you want them to be in a area that's shrinking. And when that happens, when your opportunity to take market share on a forward basis starts to become diminished and the category as a whole is shrinking, there's some worry around where the growth is going to come from. You can kind of see in Target, they're the number one player in dollar share. 20% of cosmetics sold in Target are e.l.f. And that's a good thing for sure. That's a good thing. That's a awesome sign for the company, an awesome sign for the quality of the company's product, their staying power, etc. But from a growth perspective, you have to sort of imagine we're getting up there. We're getting up there as a company. Maybe, just maybe, we're not going to grow as quickly as we grew in the past. And some of that is starting to show not only with a slowing industry, but also with a slowing growth number on our top line due to the fact that we're now the number one player in this space. We're already number one. Where are we going to go from here? If anything, there's now a target on our back versus us being the aggressor. Other companies are going to start coming after us because we're number one now. We're going to have to defend our position and also, because our stock is still immature, grow it from here in order to support the valuation that the stock market has given us. You can see, yes, share growth in Target, share growth in Walmart, now the number two player in Walmart, now we're in Dollar General, yada, 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 all of that good stuff. They are a very productive brand. Another part of the business is they do have a skin business, a skincare business that's not that mature yet. And this is potentially where the growth could come from. This was a number 25 player just a while ago. Now they're number 10. They're growing. It's a relatively young brand on the skincare side. They acquired Naturium, a skincare brand, and they're also outperforming the category. But the category is also shrinking. That's the problem with this investment in a way. You have to outperform the category. You have to keep gaining market share. Otherwise, you're going to shrink with the category. And with skincare shrinking by, basically flat, but makeup shrinking by 5%, that's sort of a problem for the growth story that this stock needs in order to support the valuation. And on the skincare side, there's a lot of runway for growth. You can kind of see the leading brand in skincare, 14% market share, which is kind of what they have in makeup. e.l.f. has 14% market share in makeup. The leading brand in skincare has 14% market share in skin. Maybe, just maybe, in makeup, e.l.f. is a bit too mature to grow at the clip that the market is used to it growing. So where's the growth going to come from? One, maybe it's skin. This only has 2% market share. There's a lot of runway for growth. Two, it could be international. They're seeing 66% international sales growth. That's only 20% penetration in terms of their overall sales. So certainly a lot of room for growth internationally. But does that offset the slowdown in growth in their biggest sector, which is the American skincare sector? That remains to be seen, and that's something we'll have to take a look at as investors. So you can see the countries they're in, you can see the disruptive stuff they've got going, but this is essentially what you're buying. You're buying a skincare brand that's relatively new-ish and one that is seemingly starting to mature faster than probably the market expected. And remember, this is a brand that started around 2005. Initially, it was very much a cheap brand. This is something you buy for $1. It's medium to low quality. It's very cheap. However, as the user of e.l.f. matured, the company matured with it. Somewhere around 2015, 2016, they started to move upstream a little bit. Some of their products became more expensive. They started to copy other high quality brands and sort of offer cheaper versions of those products. And that's kind of where they sit right now. They do offer good products. e.l.f. is a good makeup company, a good skincare company, and it's a good value. It's not the best makeup, it's not the best skincare, but it's a good value because you can look at some of these prestige brands that charge $30, $40, $50 for an item, and you've got a similar item from e.l.f. that's anywhere from $10 to $14 to $15 or something like that. So that's where the stock value comes in. That's the value proposition of the company itself. The question becomes, is the valuation too expensive despite the fall, or is the valuation now at the right price after the fall that we're seeing to reflect the potentially new normal in terms of growth? It's easier to look at e.l.f. and say, well, This is clearly a good value right now. It's growing at 30%. It's gaining market share. If you look at the adjusted EPS they provide for 2025, this is a 20x multiple at the pre-market price, maybe closer to a 30x multiple with the unadjusted EPS, which I think is more realistic because you're accounting for stock-based compensation and some other costs. But what are you actually buying here? You're buying a brand of cosmetics, and the cosmetics industry is shrinking. So is that a problem? Is that a long-term trend that we're going to see once e.l.f. becomes a mature company where it can't take any more market share or starts being threatened for market share? Is the growth going to be gone? And what does that mean for its valuation? Should it be valued at a 30x multiple or a 1.5% free cash flow yield or whatever it's valued at right now, because some of their income isn't flowing in through free cash flow at the moment because of changes in inventory and things of that nature? That's a concern. However, one could also say this is a benefit for e.l.f. And one of the reasons they're growing is that, yes, the cosmetics industry is shrinking, but it's because people are being more selective around what they buy. Because the economy is becoming a bit tighter, people can afford less and less stuff. They're making tougher choices around the makeup that they use. And people aren't going to stop using makeup. People are going to keep wearing makeup because people like looking good. However, they may look at some of these $40 to $50 brands that they're buying and say, well, I probably can't afford this lipstick anymore. Maybe I have to buy a cheaper lipstick that's 95% as good or even 100% as good, but half the price from e.l.f. And that could be a benefit from e.l.f. That could be one of the reasons that they're growing as much as they are, despite the fact that the industry itself is shrinking. However, the concern is that going to stop anytime soon, especially now that they've matured a little bit in terms of their market share as a cosmetics brand? Again, this is very much a simple product. It's a cosmetics product that you're buying. It's a brand that you're buying. And these brands can come and go. I don't think e.l.f. is going anywhere, but they weren't really a thing or a big thing before 2020. And suddenly they're one of the number one cosmetics brand. What's to say that another cosmetics brand can't start moving up the chain and start taking market share from some of the bigger players? And now that e.l.f. is one of the bigger players, they're going to be threatened a little bit because this is very much rather a marketing spend, right? This is how they've been able to grow. They've increased their marketing and digital investment budget. They've grown through influencers, through TikTok, through Instagram, through all of that stuff. And other brands can follow that playbook relatively easily. And they talked about how TikTok being cut off impacted their business going into January, how that is to blame for some of the slowdown. The fires in California are to blame for some of the slowdown. And sure, maybe some of that will happen and impact their business. But if their business is that threatened by minor things like that, does that make you feel good as a shareholder of e.l.f.? And again, this is a company that does have an okay balance sheet, so they could make some acquisitions in the future. One of the things to keep an eye on is inventory. Obviously, as they grow larger, as they have more revenue, they're going to have more inventory. But now that that growth seems to be slowing down, you have to keep a closer eye on inventory to make sure that that's not increasing as sales sort of drop off, because that's going to mean eventually they're going to have to sell items at a lower price. That's going to lead to slower growth, et cetera, et cetera, et cetera. Cash flow priorities, again, investing in growth initiatives, so probably more marketing, strategic extensions. They talked about new products, all of that stuff. So there's future expansion to come. The question then becomes, how much growth are you getting from a company like this one? And right now, that outlook is slowing. And you may look at this and say, well, before it was 29 to 30% growth or 30 to 31% growth. Now it's 27 to 28% growth. Who cares? That's such a small reduction. Why is the stock down 25%? Well, it's down 25% because the deceleration in growth is huge. You're talking about 77% growth in the second half of 24, down to 14 to 16% growth in the second half of 25. You're talking about 31% growth for Q3 of this year, this earnings release, down to low single digits for Q4 in 25. So what they're seeing in January is spooking them so much that they are taking their growth down quite a bit on a quarter over quarter basis. And the question to investor then becomes, what does that mean for 2026? If growth in Q4 25 is going to be 2%, and the market was expecting, high teens growth for all of 26, is the market now way off? Is the market now saying this probably is going to grow in the low single digits, mid single digits, low teens for 26? And even then is a big miss versus what the market expected. Even if you're in the low teens and that change from low 20s, high teens aggregated across the next couple of years is a big change to what the market was expecting. I think that's what the market's worried about. You also have to think about, well, there's some tariffs going into play. Some of the Chinese things that are happening right now, a lot of their product is produced in China. Some of it is in Thailand and Taiwan, but end of day, a lot of it is coming from China. If suddenly tariffs go into effect and they're bigger than the 10% that just went into effect a couple of weeks ago, this can impact their business quite a bit. During the 2018-2019 trade wars, they had to raise their prices by about $1. And yeah, they can go to their suppliers and ask for concessions, cut costs in their business, increase prices, drive international growth to offset some of these tariffs. But end of day, that's another risk that you have to consider as an investor. So as you look at the valuation, it's like, well, it's slowing growth, it's tariffs, it's slight inventory buildup. What does that mean going forward? And then where am I pricing this thing as an investor who's seeing a trend that isn't very favorable in terms of their actual growth potential going forward? Okay, friends, valuation disclaimer. This video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So I've put in a $66 price here, assuming that's what it opens at, because that's what it's trading at pre-market. That brings you to a $3.7 billion market cap, a $3.9 billion enterprise value. Balance sheet is fine. Can they acquire more companies, more brands? They certainly can. I think that's something they'll continue doing in the future. Naturium was one acquisition. They'll probably acquire more. Do note, not really a stock buyback company. They do have stock-based compensation that's growing quite a bit every single year, 19 million to 29 million to 40 million. For 25, it's probably going to be closer to 60, 70 million. So keep that in mind. Some dilution. Maybe eventually they'll have to offset it with a buyback. As we look at the growth here, 27.5% for 25, a 3.2% free cash flow margin. That's kind of what the market is expecting after the earnings release. The market's already adjusted, the analyst community rather, has already adjusted their assumptions for growth on a go-forward basis. 26, for example, was closer to high teens based on market expectations. Now it's into the low teens, so you can see why the stock price is moving down as much as it is. The expectations, because of Q4 being a low single-digit growth quarter, are moving down quite a bit. And the question is going to be, is this too aggressive? If Q4 is low single digits, what does that mean for 26? You're going to have to wait until management gives guidance in May. But right now, the assumptions are that this is going to continue growing in the low teens, high single digits for the next couple of years. Margins are going to keep improving. As far as final margins, I have about 10.5% here. When I look at Estee Lauder, when I look at L'Oreal, those guys are in that like 10 to 14, 15% range. I'm putting these guys on the lower end of that scale. If you disagree with any of this stuff, you can play around with this spreadsheet yourself, hit file, make a copy over here. There will be a link in the description down below. I have a buyback of 50%, so 50% of their free cash flow going towards buybacks, mainly to offset stock-based compensation, so you get a net buyback that's only slightly positive, and maybe stock-based compensation here is conservative, so you can change that as well. As we look at the valuation, right now this thing is trading at a 1.7% free cash flow yield, closer to 1% on a 25 actual basis, or 25 estimate basis rather. A 4% free cash flow yield seems relatively fair for something like this, with growth slowing, with margins improving. As this business matures, is 4% the right number? Is 3% the right number? You can play around with this by changing these factors here. I'm going to leave it at 4%, so that leaves this at a 7.2% expected return from the price point of $66. If you want a 10% target return, you get a fair value at $58. If you want a margin of safety of 10%, you get closer to the low 50s right there. You can kind of see the future price right here, anywhere from $75 at a 5% free cash flow yield to $124 at a 3% free cash flow yield, anywhere from a 2.6% return at that 5% yield to a 13.5% return at a 3% yield. So you can kind of see where my mind is with this company. Is this a good deal right now? Still seems slightly overpriced to me because of the unknowns around revenue growth. Again, If they're guiding towards low single digits for Q4, what does that mean for fiscal year 26? Probably maybe a bit aggressive on 13% right now. I think you'll see the estimates change quite a bit, which will mean this will be a pretty volatile stock because it's going to depend a lot on what happens during their next earnings call and what guidance they give for fiscal year 26. If it's low single digits, volatility is going to be very negative. This could be a stock that's trading in the 30s and 40s. If that's the case, maybe even lower. If it suddenly says, well, this, low single digit growth rate for December, for the last quarter rather, was just a short-term blip and we're back to growth again, we're going to start growing in the mid-teens again, even higher, then the stock could easily return into the 80s and 90s pretty quickly, because those assumptions really drive the stock price when you're still a young growing company, as you saw during this period when the stock exploded to $200, and as you're seeing during this period when the stock went from 200 to 60 on the basis of slowing growth. And right now, I sort of have to assume that this is probably an aggressive assumption based on what we're seeing in Q4. There's certainly pressure on their growth. Their makeup business in America is seemingly starting to mature again. Once you're number one, where are you going from there? They're still number two in dollar share, I think. So there's some potential for growth there. They're taking market share. There's the buy down potential for people who are spending too much on makeup and want to still use makeup because people are going to keep using makeup, but save money. Elf is the way to go. But there's a lot of competition still. Estee Lauder's out there, despite the struggles they're having. Their stock has done really poorly. L'Oreal's out there. Companies like Oddity Tech are out there doing some nonsense with machine learning and giving you the makeup that's right for your skin tone, that sort of thing, if you upload a picture. So is that the future of makeup? Who really knows? But it's clear that this is a competitive landscape, and it's a landscape that as a business, as a business area, makeup is shrinking right now, and skincare is shrinking right now, and people are becoming more conservative in what they spend on expenses like this one. And that's going to only hurt a company like Elf, because so much of its stock price is dependent on this growth, and that growth just doesn't seem to be there right now. So my take on this is, would I buy this? No, I don't really want to own a makeup brand unless it's a really good value, and I don't really want to own any consumer brands unless they're a really good value. Like in the past, I've owned Crocs, for example, but that was trading at a 7 to 8 to 9 to 10% free cash flow yield when I owned it, and I don't own it right now despite it being a similar value, because I'm just worried about the consumer right now. I think the consumer is becoming pressured and they're not spending as much on discretionary things, and makeup is somewhat a discretionary expense. It's still something that's going to be used, but maybe, just maybe, people will say, I'm going to focus on the 4 or 5 items that I use and not try anything else. And once that happens, could be a good thing for Elf, but probably in the long run is going to be a net negative as their growth starts to slow down, as people spend less and less on items that they're trying and more on items that they know are good and are the 5 or 6 items that they use on a daily basis, and they just stick to that. And maybe some people will buy down, maybe that benefits Elf, but as the overall makeup market starts to shrink a little bit or growth starts to taper off, that's only going to hurt a brand like Elf, which is already starting to become a more mature brand. So those are my thoughts on it. What do you think about Elf? Am I wrong about anything? Do you think this is a good deal? Am I missing something here? Do you think this is a short-term stop on the way to more growth? So leave a comment down below, like the video, subscribe. I know this is a stock that's beloved online, so maybe a lot of people will hate this video, but end of day, I have to look at valuations and see if they make sense. And to make this make sense, even at $66, you have to have pretty aggressive assumptions. You have to assume that this is going to trade at a 3% free cash flow yield, which again, maybe is the right number for something like this if it continues to grow. But I want to be a bit more conservative here. And if you want to take a different view on it, just hit file and make a copy, play around with the spreadsheet, get your own fair value, and make a decision based off of that. But as always, guys, this is not investment advice. So, do whatever it is you want. I'm just a guy on the internet talking about stocks. That's all I'm doing. I hope you enjoyed this video. Sorry that it was long. All of these videos always end up being long, but if you're still around this late, hey, good for you, buddy. You should subscribe. You should like. You should leave a comment. You should do all that fun stuff because I'll be here making more videos, talking nonsense for 20 minutes every other day or so. So thanks for watching. Bye.